Good day, fellow investors. We continue with our stock market investing course videos, all for free. You can check everything in the link in the description below. And today we'll discuss how to invest your first $1,000. It is about the strategy you will have from now till the end of your investing period. And that is the key when it comes to investing. Not that much where to invest it. That's not how the game is played. Before we start, I need to give you a proper warning. You need to check for other options. We discussed it already, a course to get a skill that will make your income quadruple. That will be much better to spend 1,000 because maybe you will double it in 5 years, but if you can make 10,000 a year based on your skill, that's something else. Of course, check for pension accounts that are not taxed if you want to invest for longer term, maybe matched by the employer, see how that works, what are your best tax options. If you have any loans at higher interest rates, pay those off. Down payment for a mortgage, maybe this was more 2010 till 2020, but maybe there are still opportunities where you live. Check for other options because, as we discussed already, investing in stocks is about the money you do not need. On that basis, we can continue discussing investing in stocks or bonds. When it comes to the stock market, the S&P 500, this is the chart from 1982 till today. It went from 100 points to 4,000 points. That is a 40x increase. Now, when it comes to something, if it went up 40 times, is it a better or a worse time to invest in something? Maybe this chart will give a better relation to how pricey it is to invest in the S&P 500 now or in general in stocks. The P ratio, the price to earnings ratio, is 25. 25 earnings yield 4%. But if we look at history, when those people invested to make 40 times their money, the P ratio was at historical lows, around 7. The average is around 15, and now you're paying a price that hasn't been seen for much part of history, and that means that relatively compared to history, it is very expensive to invest in stocks right now. Now, there is a caveat. If you invest in the S&P 500 on a monthly basis for the next 30 years and you constantly put in more money depending on your income, a percentage of your income, set it and forget it. When the S&P 500 crashes, you do that again, you buy, reinvest the dividends, it will be a good vehicle for long-term, slow and steady wealth accumulation. But if you don't think you can just constantly invest money into something like that, or you want higher returns than the S&P 500 offers currently, then you must look for other options. And the other option is just a bank account. We discussed high yield savings accounts. So 5% yield, 3 months. It is a great yield, and even Ray Dalio that said cash is trash changed his mind in his last LinkedIn letter where he says that cash is now good. And the message here is that as time evolves, some asset classes will be trash, the same asset classes will be very good at certain points in time. Stocks are very expensive now, bonds look okay, bonds cash, short-term bonds look okay, nothing wrong. So if you don't want to risk it in something expensive, you can start accumulating wealth through bonds by slow and steady learning how finances work, and most importantly, creating a habit of constantly investing on a monthly basis in something. And the following question is, okay, am I going to invest in stocks? Be more active or more passive? I don't think that there is a passive investing option, but usually what happens with people is that when they don't think, they don't know what they are doing, and then they panic. And if you look at annualized returns from 1999 to 2019, the market did okay. Some things did better, but okay. But the average investor did terrible. This is because people panic, don't stick to the strategy, go chase the hot thing, sell in panic when things are actually cheap, and that is because they don't think. So I am against a passive investing strategy, because if you don't think, you will make the wrong. Passive, even passive, is always active. There is just a less or higher degree of activity. You will make a mistake going down the road when even that passive investment turns ugly, because it's not just 10% as we discussed in the previous videos. And then again, another example, as we discussed, you need to nail the right index to just set it and forget it. So when it comes to investing your first 1000, I think that the key is to start thinking, because then those first 1000 will lead to better and better opportunities in the future. As Munger says, a lot of opportunities last a short while. So it's important to understand that in our life, investment opportunities aren't going to come along too often and won't last too long. If you're just passively invested, you will not be ready to act and have a prepared mind. And as he says, if you are prepared, on a few occasions in a lifetime, you act properly in scale, just doing the logical thing, you will dramatically improve the financial results in that lifetime. I've been investing for 20 years now, and there have been 3 periods of amazing investment opportunities and 3 not so great. You can read this in my investment course. There is a PDF, or you can pause the video and read it here, but let's just discuss it on the S&P 500. So I was lucky to start investing here. Whatever I bought went up 5 times because I was taking advantage of an emerging market that was booming in the mid-2000s. Then everything got expensive. I just invested in my Ph.D, boat, traveling, so because it was too expensive to invest in stocks. And here then everything got cheaper and I invested again like crazy, took advantage of things. Here, time to buy a house, low interest mortgage, so that was already something, as Munger says, logical to do, and all of those that did it in the 2010s, even 2020, did very well. Now it's a little bit more tricky, but that's it. Something is good at some points in time, something is bad. So over the last 20 years, I had a good time, a bad time, a great time, a good time, a great time in 2020 again, and now we are so time when it comes to investing, when you look at the fundamentals. It's not that stocks will just go up tomorrow. And just to confirm, you can see here the readiness, 6 April 2020, this is from my research platform. Portfolio completed, 100% invested, because we was ready to invest back then when the opportunity was available. And when it comes to your 1000, where you want to start, I think it's extremely important that you start just creating a habit. If you invest in $100, $200, whatever, and you make it a habit, if you invest in that habit, over time you will reap huge rewards. So just start somewhere, open a brokerage account with somebody, start putting money there, and then see what are your options. Or just if you have a high yield savings account, if you don't feel like doing nothing, you want to learn more, it's even good just to stick to bonds, treasuries, savings accounts where you get 4 or 5%. That's not bad. Cash is not trash, especially compared to the expensiveness of the stock market. And you slowly start working, understanding, so that when that opportunity comes in your life, you are ready. That's the core of investing. And if you do that 2, 3 times in your lifetime, the difference is millions compared to not doing and not thinking. That's the core of investing. So it doesn't matter where you put your first money now. As long as you put it, develop a habit and start thinking about what you are doing. Thanks for watching. Check my free stock market investing course in the link in the description below, and I'll see you in the next video.